Is October 3rd, 2024. This is the Development and Finance Committee meeting of the Housing Opportunities Commission of Montgomery County. I am Commissioner Jeff Merkowitz. To my left is Commissioner Roy Priest and the chair of the commission. And to my right is Commissioner Robin Solomon. The first item on our agenda today is the approval of the minutes. We have two sets of minutes for an open session and a closed session from September 4th, 2024. Is there a motion to approve the minutes?
So moved.
The motion has been approved and seconded. All in favor, say aye.
Aye.
Aye. The motion is approved. Thank you. The first action item, or I don't know whether you count minutes as an action item or not, but so is a updated pre-development budget for our Gankirk Farms development project partnership. I will turn it over to President Chelsea Andrews.
Thank you. Good morning, committee chair, members of the committee, the HOC team, and the public. This item is pertains to Gankirk Farms, one of the developments that we have moving forward in Clarksburg. It's a follow-up to a previous request. This commission has approved each step of the way as we move forward with development. And this is yet another step that we need to take in order to continue advancing this project. You will see that we've identified the specific items that we would be using this funding for in order to ensure that we maintain activity at the site and that we keep active all of the permits that we have affiliated with this development. I will turn it over to our real estate team, Gio Cavallasi, to provide additional details.
Thank you, President Andrews. Good morning, commissioners. So as President Andrews outlined, this is 184 unit mixed income development in Clarksburg that the commission approved in March of 2021 to proceed with. And the commission also in November of that year approved a pre-development budget of $5.34 million. The pre-development is progressing well, and the project already received site permit approvals, utility installation permits, and so forth. Building and parking permits are in progress and are expected to be approved in October or November of this year. So we project to close construction financing for this project in the second quarter of next calendar year. And in preparation of starting vertical construction, the project team requires some additional funding to proceed with utility installation, site preparation work, to pay for additional year of ground lease payment and other related pre-development costs. If you go to page 4, please. The tables on the left outline the pre-development funding to date. In the top table, $5.3 million, and the bottom table breaks down the new request of $2.1 million. As President Andrews mentioned, this is important to proceed with activities and to preserve some entitlements for the project for some of these activities to occur before the construction starts. So our request, if approved, would be funded from real estate line of credit and would bring the total approved pre-development budget to $7.4 million. There is no budget impact, and there are sufficient funds in RELOC to fund this. Any questions?
So one question is just a sort of a timing question, because I note in the memo that we say that the site and utility installation costs would typically be included in the main construction contract. But you're also saying elsewhere that staff believes that these need to happen prior to that. Could you just explain that a little bit more about what's triggering that, or why a delay would lead to additional fees and costs?
So if the permits, approved permits, are not used immediate, soon after approval, there is a chance that the adequate facilities plan that the project received approval for may be subject to review. And that would trigger the requirements, much stricter requirements that are in the current entitlement than it was when the plan was approved previously. And so there's a risk that that review would delay the start of the project, but also more importantly would impose higher impact fees on the project. So that's one reason. Another reason is to start, since we already have permits and the site is ready for this work, we can start utility installation now and prepare the site for vertical construction. That'll save us significant development time and construction interest.
So is it just that we got the permits earlier than we usually do, or?
No, the request is coming before you because in terms of sequencing with the many other developments we had ongoing, Garnkirk has been moving along. As you know, we initially applied for 9%. We're now going for 4%, but we have been moving along in a slower pace than maybe was initially projected. However, we're still moving the project along. And we do need to move forward with, and the next action that will come before the commission is the selection of the GC. But when we go out for a RFP for the GC, that's a very robust and many times could be a lengthy process, not just the procurement, but also negotiating and entering into the contract. We do not want the current site approvals, permits, et cetera, to go stale. And we are prepared and can move forward with these activities to ensure that the project remains on time, as well as ensure that we don't find ourselves in a position where the county is reevaluating our current approved permits. And so we'd like to take steps to move forward in that way. And at the same time, we will be moving forward with the RFP for the general contractor. We'll be coming back to the commission in a number of months once that process is over, and we'll move forward with the other aspects of the construction at this site.
Additional questions?
Yeah, I have a question. My question really goes to the whole cost related to building permits and fees. In the original budget, that was $1.688 million, and we're adding another $604,000. And generally in these projects, we know what permits are going to be required to carry this project forward. I'm kind of wondering what has happened that requires an additional $604,000 just related to permits and fees.
Normally, when we make our first request, we don't always or usually don't include the entire estimated permit fees because half of it is normally due at the submission of permits and half is due at when the permits are obtained. And normally we would include the second half in our final development plan or one of the requests closer to construction closing. And this is the case here. This also includes impact fees, the budget here, and other related fees.
And what's the rationale for that again?
Just not to obligate more funds that are needed for that initial permit submission. We wouldn't include the entire estimated permit fees in that initial request because that could be 2 or 3 years between the permit submission and final permit issuance. And so we wouldn't have to obligate more than we need at that point, and we would come back to request the second half when it's appropriate.
Yeah.
As I understand it, Roy, I think your question is related to mine in that it sounds like we've moved costs up, like costs that would have ordinarily been covered during the construction period.
Yeah, right, exactly. We're pulling together what would normally be closing costs into the pre-development. And just to add one other, for the record, Zachary Marks, Senior Vice President of Real Estate. So the other detail I wanted to add is that this apartment development pad is actually a part of a larger planned development that has been otherwise built out. So one of the other reasons why you're seeing, normally you don't see this kind of pressure about, worrying about the recalculation of the adequate public facilities, because normally our APFO calculation was a part of our specific entitlement for our specific deal. But the way this overall plan development worked, there's a huge townhome community that's already built out. That was a part of, and this apartment pad was the last piece of that. And that plan development was approved as a whole a long time ago. And so that's why you're seeing this wrinkle here on Gardenkirk as opposed to most of our other transactions, because the APFO calculation was done a while ago when Clarksburg, as you know, growing fast, was in a different place. And so it's a much older APFO calculation than is typical for our deals, where we don't worry about the recalculation because it was done specifically for our deal and it was done relatively recently. So that may also help in terms of why there's this pressure to do this utility work, because once you basically get a shovel in the ground and do some level of site work like this, it vests you and you don't have to worry about that anymore. Like, it takes away that risk.
You don't lose basis by doing these, the ones that are eligible. You've got an inducement resolution, so you're not losing credit basis.
Right.
I wasn't here 20 or 21. When did you join?
In 2020.
So I don't know anything about the deal. Are we the sole developer partner, general partner?
We are partnered with Duffy on the development side. HOC is the 100% owner of the improvements in this particular development, and Duffy is the landowner. And right now there's a ground lease in place between the project.
Will be the sole general partner or managing member
Yes, HOC will be 100% GP.
and get all the guarantees, or
Yeah, it's just going to be us. So it'll be in terms of the vertical ownership, ongoing operation of the deal, other than it being a tax credit deal. HOC is the only party involved.
and What's the split on developer fee, if any?
80 is it 80/20? Yeah.
80,
And-
80 to us.
No, 80 to Duffy, 20 to HOC.
Yeah, and one other note here is that we entered into this deal after it was fully developed. So we really have taken our role in the development process has come after site plan approval. So all the entitlements are already done.
Who's giving the development guarantee and lease up guarantee?
It's same as everything else. So completion guarantee, but
But we're giving it.
completion guarantee from the developer, but otherwise HOC is giving the guarantees around the tax credit investor, the prospective tax credit investor.
The rent up for just,
Yeah, insofar as there's an issue with lease up, obviously our plan here is, for it to be a tax credit deal. So unlike our HPF deals where there is market rate, risk to lease up, we're envisioning this as basically an affordable transaction. So
no, I get that. But, it's great that it's 100% under
Somewhere
median,
around
yeah, under a median income. But I'm just trying to understand who's on the hook for building the project to the investor.
yeah, so again, it's going to be HOC and the capital partners, and then the developer in terms of delivering the project. That's, they'll have that completion guarantee.
They're giving the guarantee to the investor. Duffy. I'm just failing to understand.
Yeah, so I mean, typically what we do is we keep the actual developer separate from the investor piece. So I mean, this is a little bit of a nuance. It's the same practical outcome, but again, like so Duffy, our development agreement with Duffy will have.
You're hiring them as the builder.
Exactly.
And we're giving the guarantee to the investor.
Right.
And release of development guarantee goes from construction through stabilization. So we're giving that.
Right.
And we're coming up with all the pre-development money.
What's left of it. Yeah. They spent money to get it all the way through entitlement, and then we entered the deal. And so we've been taking it from there because we wanted to we did things like add family units and, really change the mix.
No, it's great that it's 100%.
Yeah. Well, and adding like 2 or
Median
3
and
bedrooms and that's what.
But we're giving all the guarantees to the investor. I don't have the sources and uses for the deal. I think that would be helpful. I've mentioned this before. Sometimes it'd be good to see the org chart. It's just a cut and paste from one of your tabs. But I don't know the sources and uses, so I'm trying to catch up.
Right. Commissioner Solomon, what I can do is provide you with the packets and the materials that date back to the 2021-20 timeframe in which this transaction was approved and negotiated and agreed upon by the commission. The executive summary does outline high level in terms of our relationship with Duffy, our long-term lease arrangement. And then this particular proposal does include what the sources and uses are for the pre-development funding. But we can provide you with additional
I'd love to see
information.
what you think.
And I do want to highlight, sources and uses of the project fund. The entire project fund are also included in the materials provided on slide 10.
I didn't see that.
And so
For
it
the
outlines,
permanent sources and uses?
yes. It shows, and it says that our final approval in terms of final development plan and financing, of course, as always, will come back to the commission, but it does provide in our packet on page 10, the sources and uses for the project fund. And as I mentioned before, a high level overview of the relationship. So what I can do and what the staff can do is provide you with the background information. And the other thing that I will also talk to staff about, I know we also preloaded information about each of the transactions or each of our prior proposals in Diligent. I need to make sure that it's archived in a way that you can also simply do a search in Diligent if you're curious to look at any particular project so that you can see all the former actions that have taken place.
I'm sorry, I missed the sources and uses. That's my mistake.
Okay,
But we're giving all the guarantees. We're putting up all the pre-development money. I'm sorry, I didn't look at the sources and uses. I just missed it. I would hope before we do another deal like this, we'd revisit the splits with future. I'm not trying to undo what was done in the past, but 80-20 doesn't seem like a good deal to me. They're getting a builder's profit, right?
I mean, that's what you, I don't believe.
Actually, you're hiring a contractor. It just before we do another deal, it'd be good to revisit splits like this if we're doing all the pre-development funding and we're giving all the guarantees.
By the way, the 80-20 split would be for the non-LIHTC portion of the fee. The LIHTC portion
Oh,
of the
okay.
fee would be HOC's entire.
Okay. And is that on slide 10 or is that?
It has the total development fee projected in the uses, and you can see that in the sources, part of the LIHTC fee would be deferred, but only part of the total fee is split
Okay.
with stuff.
My apologies for missing that slide. So thank you.
Additional questions?
no,
I know this isn't really part of what's before us today, but I was looking at the note that said staff is evaluating several options for final affordability mix. One of the options is 100% affordable LIHTC. So I could not remember. What was the previous discussion about affordability mix?
Right. The previous discussion was we were pursuing a 9% LIHTC.
Right.
And we received indication from the state that we weren't awarded the 9% LIHTC. And so we're pursuing 4%.
Okay. But in terms of the unit mix and affordability, was it always 100% or?
Right.
So with, we've had a few different, so for a while there was with Garnkirk, we weren't sure if we wanted to take it the HPF route or if we wanted to take it the traditional LIHTC route. And with the caveat that we haven't, really come back and presented you that full scope. Some of the issues that we were really thinking about deciding upon were, these are rare opportunities up in Clarksburg. Right. So the team has spent some good time really redesigning the property to create those 2 and 3 bedroom units. So it's a really nice family project. And so with the caveat that we haven't presented you anything, like one of the things that resonated with us was the fact that this is a great opportunity, great location, great part of the county to really maximize our affordable unit. And because it's a smaller transaction, which we don't normally do transactions that are quite this small. And so it does have the opportunity to work as a fully tax credit deal. And whether it's exactly 100% or it's, 80, 90, 100, but it's definitely separate and different from our HPF model where you have the majority.
Yeah, and trust me, I'm not arguing against 100% affordability. I was just trying to understand what we had been presented with in the past and whether this was a different unit mix. I mean, one of the questions I did have, and this goes back to some previous discussions, is with studio apartments, and we had some discussion. My understanding was that there had been a previous commission resolution. No, okay.
There was no resolution. There was.
I know not during your time or my time.
Right. We were never
but-
able to locate, and we did do the due diligence around
Okay.
trying to locate if there was a vote or a commission full decision on zero studios. There was no formal position taken. Although there were commissioners who had strong positions on if we should incorporate a studio or not. And so I think there was a sentiment by commissioners that we should not include studios, but I think that was also under the auspice of if you're going to have a mix of market and you're going to have affordable, and we don't want you to push all of your studios only in affordable, as though you're giving the affordable rent tenants smaller space, or really taking on a policy where you're not thinking about even the larger families. This particular development model incorporates all sizes for all different families and is 100% affordable. The other point that I will raise again in regards to the anti-studio position that's been taken, I lived in one for, oh my goodness, many years throughout law school. It's the only way I would have been able to live in the Washington, D.C. area. But it also is something that for some of our family members or residents that have mobility challenges, they find to be easier to mobilize and move around than a door and a walk space that requires you to go into a smaller space. And so there are people who enjoy the open floor plan and people who don't. In this particular circumstance, you see that we do incorporate studios, but we also, the vast majority of our spaces include 1 and 2 bedrooms. And so.
And if you want to just like slide 9, just really quickly, just to keep the continuity. So there, with the 9% transaction, it's the same bedroom mix from when we showed you the 9% transaction. There are some small changes to the AMIs, but you can see there's still a really nice mix between 30 and 80. And then just again, want to highlight for, if you look at there are 30% 2 bedrooms and almost 30% 3 bedrooms. And so that was because of our intervention. That was not the original mix. And so Gio and the team did a really great job of trying to maximize our family units here.
Yeah. No, thank you. And I appreciate, Chelsea, that you went back and looked. And I don't necessarily disagree, and especially when it is 100% affordable. I think the sentiment about, not pushing all the studios into just the affordable mix remains an important consideration. But we're talking about something different here. So, and yes, Zach, thank you for highlighting the 30% units. As you know, that's where I see the greatest need. So always appreciative of when we can build some 30% units into a project. If there are no other questions, I will entertain a motion to support the staff's recommendation.
Motion.
Second.
All in favor, say aye.
Aye.
Aye. The motion is approved. Thank you. The next item on our agenda relates to the renovations at our Metro Point Apartments in Wheaton.
Thank you. Commissioners, we continue to advance Metro Point. As you can see, the staff really took the time to evaluate how we can move forward with repositioning Metro Point, as well as thinking about how we can improve the actual property for our current residents, and deepen affordability at the same time. We're pleased to present a proposal that would actually significantly increase the affordability at this very key site that is right above a metro, centrally located in Wheaton and downtown Wheaton, and also afford us an opportunity to improve not only the structural components, the roof, et cetera, but also enhance the exterior of this property. And in turn, and also ensure long-term affordability. With that, I would like to turn it over to our real estate team. This particular project is led by Alex Lauren, our housing acquisition manager.
Thank you, President Andrews. Good morning, commissioners. For the record, Alex Loren, Housing Acquisition Manager at HOC. Here today to propose the preliminary development plan for the renovation of Metro Point Apartments, be supported by Development and Finance Committee for presentation before Commission on October 9th. Metro Point is a 173 unit development built in 2008 above the Wheaton Metro Kiss and Ride, as Chelsea mentioned. Since 2008, Metro Point has consistently struggled to maintain positive net operating income, with HOC supporting the property by funding its annual operating shortfalls. So a major focus of the proposed renovation and resyndication of the property will be eliminating these shortfalls and putting Metro Point onto a sound financial path into the future. With the renovation, we're targeting both interior and exterior upgrades to enhance the asset's marketability, reinforcement of structural systems, and reinvestment in building systems. Back in July of 2024, Zavos Architecture and Design was selected as the architect, and a pre-development budget in the amount of $1.4 million for fiscal year 2025 was approved by the commission, allowing for the start of investigative engineering studies and design. We're currently proposing the preliminary development plan in which the affordable restricted units would be increased to 70%, with rents offered at 60% AMI by income averaging, and thereby expanding affordability at a transit-oriented location while maximizing LIHTC proceeds and issuing new tax-exempt debt to replace the existing taxable and tax-exempt debt. Total costs for the transaction are estimated to be $71.3 million, to be funded with an FHA risk share mortgage, 4% LIHTC equity, a seller's note, and a renovation escrow balance. The balance of sources needed to finance the transaction would be sourced through a combination of green energy grants, loans, or HOC funds, which will be presented to Commission at a final financing plan. A summary of those sources and uses can be found on slide 9. Can you skip to slide 5, please? So as mentioned, the strategic thesis behind reinvestment in Metro Point is to bring the property in line with HOC standards for high quality, modern energy efficiency living standards while preserving and expanding the affordability within a submarket illustrative of growth, and to create an improved living standard for residents while putting the property onto a sound financial path. Next slide, please. So on this slide, we've highlighted a few of the areas we'll be focusing on for the renovation, which will improve building systems, such as the roof replacement and replacement of mechanical, electrical, and plumbing equipment and fixtures with those that are more energy efficient. The renovation will also target improvements to the building facade and finishes to both the amenity and common areas and the units as well. Next slide, please. This is illustrative of the current unit mix on the left, with 30% affordable units at 30% and 50% AMI levels, alongside the proposed unit mix of 70% affordable units, income averaging to 60% AMI. Next slide, please. So here you'll see some images illustrating the quality of finishes existing at Metro Point, as well as some images illustrating the finishes at the comparables within the submarket of Wheaton. And you'll see our current weighted average market rent here of $214 per square foot relative to those comps that we've been looking at, which are slightly higher. Please skip to slide 10, please. So based on the sources available, the construction budget has been set to $10 million, or roughly $58,000 per unit. So while we have targeted the categorical items listed based on the prescribed budget, we will be engaging a construction manager to better assess the cost estimates of the items listed over the next couple of months. Slide 11 provides our overall timeline, which we're still targeting June of 2025 transaction closing. So we anticipate coming back to commission at the end of this year with a request for approval of a general contractor as well as submission for LIHTC. And then the final development plan and financing plan will be presented in March and April of next year. That concludes my presentation. I'll take any questions at this point.
So just looking at the preliminary sources and uses, the projected funding gap of 4 million, is that what you're talking about when you say that we expect to fill that with the combination of green energy grants, green energy loans, HOC funds?
Yes.
Okay. On the, I think, very supportive of the increased affordability, the overall increased affordability. I just want to make a note, if I'm looking at the mix correctly, while we're increasing the overall number of units that are affordable, we had 35 units that were affordable at 50% AMI, and I mean we're increasing the number of 30% units by 2, but it looks like there will be no more units affordable at below 60% under the new mix. Is that right?
That's so this is a projection of what a unit mix could look at averaging 60% AMI. Mm-hmm. So we could take a look at other scenarios where we income average to 60% AMI, where we preserve those lower levels of affordability as well.
Yeah.
Yes, and we are, of course, not only trying to do income averaging, but our real estate team, of course, is taking into consideration how to ensure that we're able to balance taking away the market rate here, right, and the long-term viability of the development with significantly reducing market.
Yeah, no, I'm not necessarily opposed to that. I'm just noting that, looking at what the trade-off is here. Is that
I do want to just also note, of course, voucher holders are able to utilize their vouchers here, but there also are some potential other sources and conversations that we're having with the state in regards to a rent supplement program that would also allow for lower AMIs, even in the 30% range, to take advantage of and be tenants at this site. So we're in those discussions and can incorporate that in the near future when we're able to memorialize what that would look like.
That would be great as well. But so I guess the final question I have just in relation to this is, if we did have to sort of eliminate the 50% AMI units and move them basically up to 60% AMI, what happens to the residents who are in units where they've been?
Right. With all of our affordability mixes, we always factor in just transition time. Mm-hmm. We do not displace residents. And so as time goes on, we ultimately work our way to the approved mix that the commission has identified.
Okay. Probably you have turnover every year. You probably stop leasing after a little while.
Right.
Right.
And then, of course, with LIHTC, when someone's income goes up, you don't displace them. So we're really going to just adhere to those requirements.
I just want to make sure that, we're not just suddenly hitting them with a giant rent increase. So, okay. Are there other questions from the commission?
I don't have any questions, but I do applaud the fact that we have increased significantly the affordability in this development, as well as we continue to support energy improvements. I mean, we celebrated that at Hillendale, and we want to make sure that as we go forward, we do as much as we can to take advantage of those savings sometimes get created, both to the resident as well as what we do in the development for getting grants. So I certainly applaud that. And the other thing I would just recommend, and this is, I hope I can say it correctly, but I think it's really great that we engineer to get as much affordability as we can in all of our developments. But I think also what it does is put some pressure on us also to be able to align our resident services programs to service those populations as well. Because, I think that there is a need to do that as we drive our affordability down lower. We want to make sure we can support our residents in terms of self-sufficiency strategies, improving income, not just simply bringing them in at 30% or lower, but the idea is to help them grow, and we've got a span of affordability here, so that's great. So I certainly recommend that we advance this forward to the full commission for their approval.
I've got a question if that's okay. Are there net sales proceeds after the seller note and the first mortgage and whatever? They're selling it to themselves.
Oh.
And I didn't know if there are proceeds.
All of the proceeds would be, so we're planning on taking out the existing debt.
Right.
There would not be any proceeds
Left over.
Yeah.
I'm curious about the, when you sell to yourself, you have to bring in an unrelated party. You just can't sell to yourself for 100%, flip it to yourself. And we could talk about this some other time, but are there any economics going to the unrelated party, or who is the unrelated party to the extent? Or maybe this is a better conversation for elsewhere.
I think this would be further developed when we get to the financing plan. At that time, when we present it.
I mean, you've done this before, and I'd be curious, just cash flow. The developer entity can be 100% us, but the owner of the entity of the GP has to be, round numbers, 51% somebody else. And I'd just be curious. Maybe we talk about it offline.
There has been a motion to support the staff's recommendation. Is there a second?
Second.
All in favor, say aye.
Aye.
Aye. The motion is approved. Thank you.
Commissioners.
The next item on our agenda has to do with some pre-development expenses for Heritage Emery Grove. And I will turn it over to President Andrews.
Thank you. Commissioners, Heritage Emery Grove is a development that we're really proud to support and advance. The last time we came before the commission, we were focused on our parcels, Camp Hill Springs, as you know, as well as trying to ensure that we moved forward with our portion of the site. We also are serving as stewards on behalf of the county and ensuring that this property is revitalized, and in doing so, provide support and are the conduit for developing the parcels that will be community amenitized. And so today what we're presenting is the next steps that we need to take in terms of permitting and moving forward with the overall development outside of HOC's parcels. And I'll allow our real estate team, Jay Shepard, to walk us through this recommendation.
Thank you, President Andrews. Good morning, Commissioners. For the record, I'm Jay Shepard, Housing Acquisition Manager. And starting on page 3 of the executive summary, I'll just give some overview. And then at the end, if you have any questions, please let us know. This packet again outlines the Heritage Emery Grove redevelopment and includes an updated budget and request for authorization to draw additional funding from the $150 million reloc line for pre-development activities. Prior to this, the commission approved feasibility funding to explore and develop the opportunity and obtain the right-of-way abandonment work and the ZTA for the Camp Hill Square and Emery Grove Village parcel. We're now at the process where we're ready to begin the transfer of the county-owned parcels to HOC, and funding for the initial phase was $150,000. That was approved under Resolution 20-35 AS. And so this next phase, which advances the master planning of the DGS parcel, which is parcel 6 and 7 on this map, to HOC, as well as the MCPS site, which is parcel 7, which is also known as Pepper Ridge. We are asking for the budget to be increased from $422,500 to $1,721,500 to include $1,299,000 of additional pre-development funding And that'll allow for activities such as land planning, civil engineering, concept architecture, legal, marketing, and outreach campaigns that's required under the master plan implementation. The source of the funding, as I mentioned, was the relock, and that'll carry interest and be paid for out of the funds that we're drawing for a term not to exceed 60 months. And then payback is occurring at either the closing on the property dispositions at the end, or if there's a construction financing for the first phase of any of the redevelopment projects. Page 4 underneath this page shows the various parcels again that I mentioned. So the Upcounty Park property as well as Pepper Ridge. And the next page, page 5, shows a little history of these parcels in relation to the vision that really has grown to become Heritage Emery Grove. So with that, if you have any questions, please let us know.
Are there any questions from the committee?
I don't have any questions. I just think that this is a project that has been very well received by all of the partners in the county, including the county executive, and the fact that they put their parcels up very quickly for us to be able to do this and working in conjunction with the church. I remember going to one of the early meetings with church on the Sunday. Almost the first meeting you went to as the president was at Emery Grove. So I'm very happy to support this recommendation to go forward to the full commission.
Is that a motion?
Yes.
All in favor, say aye.
Aye.
The motion is approved. Thank you. Great.
Thanks.
Okay. The next item on our agenda, we have another opportunity to take some alternative placements for MPDUs. And I will turn it over to
Yes.
President Andrews.
Thank you, commissioners. As you know, we work in partnership with the county when there are developments that cannot meet the MPDU requirements for one reason or another. In this particular circumstance, there is at least a little over $1 million worth of alternative placement that we would like to receive to support our developments and to ensure continued affordability in the county. I will turn it over to Zachary Marks, our Senior Vice President, to provide additional details.
Thank you, President Andrews. For the record, Zachary Marks, Senior Vice President of Real Estate. So this, if you may recall from earlier in the year, we had 2 of these as was mentioned, and so this really follows the similar path. It's really another one of these high service senior communities that comes with a large service fee that even if the rent related to the unit is affordable, the service fees are not. And so very much in keeping with the same way in which we structured the alternative placements previously for the previous 2 earlier this year, Heritage Potomac, we're taking the same tack with Heritage Potomac. The aggregate payment is as President Andrews mentioned, it's just a shade under 1.4 million. Go to the next slide, please. So this just provides some of those same highlights, similar to the previous packets. As you can see, the service fee is very large. This is and one note about this particular property, it's way out in Potomac. It's really out. I don't know if you know South Glen, but this is really toward the western end of that road. So this is way out in like the very low density single family neighborhoods, not near anything else other than those homes. And so I'll just double back on that point in a second, but the alternative placement here, you can see there are 59 units out of the 145 that qualify for the MPDU program. If there are any questions around that, let me know, but it's essentially just different technical things that because most of the time assisted living is exempted from the MPDU program. There's a nicety here though about those with full kitchens are treated as under the MPDU program. So even though it's a 145 unit property, from the perspective of the MPDU program, there are 59 units that actually are covered under it and non-exempt, and that creates the nine MPDUs required. Next slide, please. Just to refresh everyone on some of the really, some of the innovations on previous alternative placements that HOC and DHCA work together on coming up with. We have an opportunity here to place alternative placements at not only existing, but also new construction. That was an innovation previously. The expectation is they would just be placed at existing properties, which often meant you were getting older MPDUs in exchange for new building. And so this allows us to, where possible, better align getting new MPDUs, new construction MPDUs, and again, net new. I know Commissioner Merkowitz mentioned this previously. These would be net new and above what we would do otherwise in the event of new construction, obviously on existing.
Thank you. I was planning on mentioning that again.
I remember the comment. So, and then obviously for existing, it's taking market rate units and making them MPDUs. So it's net new in each case. But there's two other cool things here is that basically we create this escrow situation where we can wait for new construction opportunities to be ready, so they don't have to be perfectly aligned, which obviously rarely happens. So we do have the opportunity to escrow that money, and then of course while it's being escrowed, we can use the interest off that money to create short-term rental assistance for residents of the county. So that's another nice feature of this. Next slide, please. Actually, I'm sorry, real quickly, if you could just flip back to the previous slide, just in the bottom right corner, there's this map. So I just really wanted to emphasize that. One slide down, please. Other direction, please. Yep, thank you. So you can see the yellow dot, and that looks like the sun in the upper left corner. That's how far out this new senior community would be. And you can see for folks that would live in rental units, that really is a disconnect from instead being, we would provide these new units, these alternative placement units in the Bethesda CBD, which, obviously a lot more readily available in that location. So the final slide is just the recommendations, and similar to the previous requests, it's really, so final slide, please. So again, it's really just an approval to accept the payment. The documents that govern this are all the same documents around our MPDU with DHCA, MOU with DHCA around that really outlines the structure of what we do with the money, as we've explained here, and then our agreement with the developer itself, who the developer makes the payment direct to HOC. If you have any questions, I'm happy. Oh, and I wanted to correct one error. I forgot to change the staff recommendation, so it's still referencing the old packets. And so really the issues for consideration language is the correct request, and I apologize for that error on the bottom.
Can we go back to slide 4? Thanks. Says alternative placement payment of 130,000 per unit, 9 units. This generates 1.345 million. Could you help me on the math there?
Yes. So really it's walking backward. So I tried to write it in a way that would somewhat make sense, but basically the 1,345,500 is the actual number that was negotiated. And it is basically, it includes a 15% premium. So if you take the 130 by 9, then you add a 15% premium for basically giving this developer this option. And so I will try again at that paragraph.
Okay.
I was trying to figure out the best way to explain it.
We'll include the premium in the.
But basically, that's the difference. Because if you do 130, I think you get like 1.1 or something like that. It's because one of the things DHCA and HOC agreed to is that the developer should pay an extra premium for the the ability to do that. So that's what's included there. So my apologies.
And, you know, I think it makes total sense not to do MPDUs, you know, all the way out there where there's nothing. And, I mean, at least not for the income units we're serving. But, I am curious, you know, moving things all the way to Bethesda. I mean, do we have other properties in Potomac? I think it's great that we're doing as much as we are in Bethesda, but it's not the only, you know, sort of area of opportunity.
Yeah, we looked at it. It's a good point because Bethesda is not even technically like as the crows flies closest. And so just a few comments on that. One, this is way out in Potomac. So, and there is nothing for really 4 or 5 miles that even has substantial rental properties, period, whether we own it or not. There isn't. So for instance, if we wanted to pick as the crow flies, the closest is really almost like either Rockville Pike or Rockville. The reason we stuck with Bethesda is it felt like we just made a judgment call that the downtown Bethesda CBD is the closest approximation of Potomac, which, as we all know, is extremely affluent, but just provides absolutely no opportunity. So we have almost nothing in Potomac. We have like Brook Park, which is already 100% affordable and, you know, 17 units. But it really speaks to how little that there's really the total absence of rental projects for anybody, whether we own it or not, for about 3 or 4 miles. So really the choices would be as the crow flies, maybe you pick like the Rockville CBD or maybe Rockville Pike, where we have some stuff. But we felt like those weren't even as comparable just from a value standpoint as Potomac and Bethesda CBD. But that's pure sort of judgment call based on our feelings about the market. But you may have a different.
No, I'm not opposed to, you know, given those realities. I mean, I think just kind of going back to some of the discussions we had in the strategic plan about thinking about geography, and, you know, and the, you know, the Garnkirk development is a great example of us, you know, putting, you know, helping to create affordable housing where there's very little of it already. And, you know, Potomac may be another place, but, you know, looking for those areas of opportunity, you know, where there just isn't a lot of affordable housing already. You know, doing what we're doing in Bethesda is great, but I want to make sure that we're covering other parts of the county.
Yep. Thank you.
You know, since there's no time pressure to use this money, and since we have longer term ambitions to do redevelopment in Bethesda on those properties that we are now acquiring, these investment of those dollars into one of our new construction opportunities would give us again a net additional increase of affordability.
Exactly. Yeah. And that's precisely what's envisioned here that was why we were so pleased with, you know, the work that DHC and HOC were able to do together here to really have envision that and say, hey, HOC's clearly got opportunities in Bethesda, but we know the timing of new development is not going to just magically align with something that comes out, you know, comes up very quickly here. So what we would do, so the general idea here is within the MOU, there's kind of a blanket statement that says the HCA is good with anything HOC has in the Bethesda CBD. And so you're not approving one or the other right now. So what would happen is, for instance, if we had a development opportunity in Bethesda, we were ready to start bringing it forward, then we would say, hey, we think this is a great place for it, and then ask for your explicit approval there. Yeah.
Are there any other questions from the committee? If not, I will entertain the motion to support the staff's recommendation.
Second.
All in favor, say aye.
Aye.
The motion is approved. Thank you.
Thank you.
The final item on our open agenda today has to do with the potential disposition of additional scattered site units. And
Thank you. Commissioners, we appreciate the support that we've received from the board previously, or the commission previously, related to a new approach with our scattered sites, in particular, those scattered sites that have extraordinarily high capital needs. That means between $125,000 to $150,000 worth of capital needs to bring back online. We presented a comprehensive strategy and plan around scattered sites, and identified the potential of home ownership as being a way to really partner with nonprofits and create additional long-term affordability, also as it pertains to our strategic plan, tying into the concepts around equity and self-sufficiency and allowing for us to provide those opportunities. We had a wonderful partnership with Habitat and kicked off this initial concept a number of months ago that was successful, and they are and have already closed on a number of those properties and are working through the construction or the revitalization of the remainder of that portfolio to advance for affordable home ownership opportunities. In this instance, we are seeking support from the commission to advance another 10 sites. This particular request is also supported by the county, who has identified some funding sources to provide to Habitat as it pertains to revitalizing these properties and ensuring long-term affordability, as well as first-time home buyer opportunities. These sites are in Montgomery Village, which is a location where we do have a concentration of scattered sites. And so being able to afford some home ownership opportunity there is also a wonderful attribute for this recommendation. I will turn it over to Jay Shepard, our housing acquisition manager that's leading this proposal, for additional insight.
Thank you very much, President Andrews. And you actually covered quite a bit, which is really great. I'll just add a couple points.
This happened last time, I think, too.
Yeah, it does.
You
It's
just
very
stole
good.
your whole.
Like being, no, it's really good. And for the record, sorry, I'm Jay Shepard, Housing Acquisition Manager, Real Estate Development. So as President Andrews mentioned, this is a formal request to proceed on the disposition of a second batch of 10 scattered site units, primarily in Montgomery Village, to Habitat for Humanity of Metro Maryland. And the commission sold the first batch to Habitat for the exact same terms that we're coming to with you today. Habitat does take these units and they convert them from rental units to home ownership. After they make a significant capital investment, they secure sweat equity home buyers who participate in the portion of the renovation to the work, and they identify folks in the 35 to 63% of the area median income range. And as President Andrews mentioned, they've been already working through that first batch. They've closed on 2 of the homes, and they're working on the other 8 in the demolition rehabilitation phase, and identifying home buyers for those to ultimately bring in to participate for their sweat equity engagement. This particular sale, as I mentioned, the sale price is $90,000 per unit. It is sold in an as-is, where-is condition, and the closing costs are paid by the buyer, or Habitat in this case, and those are estimated to be about $50,000. The sale prioritizes older units with high capital needs in areas where HOC has an abundance of inventory or has ample opportunity to acquire new MPDUs. While this disposition does not yield proceeds for acquisition of new MPDUs, it does create home ownership opportunities for low and moderate income households at one end of the affordable housing continuum. It also further aligns with our goal 2 and C, of the new 5-year strategic plan, and that's to enhance wealth creation and homeownership programs to further housing equity. So therefore, staff is hereby requesting your support and recommendation of the commission authorizing the disposition of the 10 scattered site units for $90,000 each to Habitat, covering costs related to closing and for their ultimate use in strict accordance with their program restrictions. And please let us know if you have any questions at this time.
Are there any questions?
I don't have any questions, but I just think that this is really innovative and creative approach to how we can create home ownership. And wonder what we've done to publicize this. We've already sold 10, and two of them are already under sale. And we've got 10 more coming. We ought to be able to publicize this and get a few good kudos for this.
Yes,
So-
we're working with Habitat and our communications team to do a joint press release and to celebrate this collaboration, as well as at the same time announce in the future an opportunity for other nonprofits to consider working with us in this regard as well.
I was going to ask what their capacity is to do more, or is it sort of blocks of 10 or so?
Ultimately, they'd like to get up to 50 a year is what they've expressed to us. But they have to build that capacity.
Are there other Montgomery County entities that have the capacity like Habitat or yours?
Yes, there are other nonprofits, and that's why we want to do a larger communication campaign and allow for other nonprofits to consider this model. And then at the same time, we have to come back to the commission in regards to what does that mean about our portfolio? How do we move forward? Do we want to begin to acquire additional MPDUs or have a different thought around our entire portfolio mix? But this definitely has been a win-win scenario. We're tiptoeing into it, and we definitely want to celebrate it because there will be new first-time home buyers moving into these units here soon.
Yeah, you raise an important issue. I know there have been previous commissioners who felt very strongly that, our scattered site units were, one of the things that made HOC both unique and special, and the number of units we have. And so, I'm very supportive of the strategy that we have here because, we are taking units that have, we're getting no use out of, they're not occupied, they're vacant, we're not getting income out of them. We're creating affordable home ownership opportunities. So I think it is great. I don't think we necessarily want to, spend down our scattered sites completely. And so, yes, at some point we want to take a look at the extent to which, how far down we want to go, to what extent we may want to build back up.
And taking into account the management difficulties of
Yeah,
scattered site.
absolutely.
It's
Yeah.
hard.
It is.
It's hard.
Yeah. So, which is, I gather, part of how we ended up here.
But what a great.
It is great.
It's a great
And
effort.
also, kudos to Habitat for moving quickly on the 10 that they've already acquired. So it's, yeah. There's a motion to support the staff's recommendation. Is there a second?
Second.
All in favor, say aye.
Aye.
Aye. The motion is approved. Thank you.
Thank you.
Thank you.
If there are no other items for the final agenda, for the open agenda, pursuant to section 3-305B and D of the general provisions article of the annotated code of Maryland, I move to adopt the written closing statement dated October 3, 2024, and to adjourn this open session to a closed session to discuss two topics. The first topic is the potential acquisition of an interest in real property located in Rockville, Maryland. This topic must be discussed in closed session in order to protect HOC's bargaining power and to protect confidential commercial and financial information provided to HOC by third parties. The statutory sections that allow this meeting to be closed are sections 3-305. AI is taking over. The statutory sections that allow this meeting to be closed are sections 3-305B3 and 3-305B13. The second topic is various financing actions for real property located in Bethesda, Maryland. This topic must be discussed in closed session to protect confidential commercial and financial information provided to HOC by third parties. The statutory section that allows this meeting to be closed is section 3-305B13. If a member of the public that is watching this meeting in real time on YouTube wishes to object to the closed meeting, please comment in the YouTube chat box or contact HOC's general counsel. Instructions can be found in the Open Meetings Act objection procedures, which is posted on HOC's website. Do I have a second?
Second.
All in
Second.
favor, say aye.
Aye.
The motion is approved and the open session of this meeting is now closed and we are moving into closed session. Thank you.
Thank you.